Doomsday nears. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, the worst case scenario is about to strike the U.S. economy, and you're not going to believe what Wells Fargo and Charles Schwab had to say about this because they don't realize just how bad things are going to get. And if you're wondering what we're doing in this empty office building, well, the worst case scenario looks a lot like this, and it's coming far sooner than policymakers think. And with that, let's head over to the conference board where we picked today's story up because we want to start out talking about the consumer, because in our economy, it's all about consumer expectations. And here we can see U.S. consumer confidence fell again in October, but notably, the headline says that they remain pessimistic about the future even as they continue to spend. So you see kind of an issue here is if you're pessimistic about the future, typically spending tends to go down. And if spending actually rises, as what the article here is suggesting, then that means the future is actually be far more optimistic. But are they right? Is it possible you can actually have an increase in spending and at the same time the future looks bleak and then it turns out that it happens that way? Well, the answer is it absolutely can. Here we can see the Consumer Confidence Index declined moderately in October to 102.6, down from an upwardly revised 104.3 in September. And notably, consumer fears of impending recession remain elevated, consistent with the short and shallow economic contraction we anticipate for the first half of 2024, which seems to be the base case for everybody, including the Federal Reserve and other policymakers. They think, well, we're going to have a mild recession, just a slight slowdown in early 2024. But of course, we know it's going to be far worse than that. And wait till you hear what Charles Schwab and Wells Fargo said about it. It seems like everybody just happens to be in denial of what is coming. And yet consumer confidence fell again in October, making 3 consecutive months of declines. October's retreat reflected pullbacks in both the present situation and expectations. So present being, how people feel about the economy today, expectations looking out over the next 6 months and what they think is coming. Rising responses show that consumers continue to be preoccupied with rising prices for grocery and gasoline in particular. Consumers also expressed concerns about the political situation and higher interest rates. Worries around war and conflicts also rose amid the recent turmoil in the Middle East. Declining consumer confidence was evident across households aged 35 and up, and not limited to any one income group, suggesting that these declines were broad-based. And that's not what you want to see. When you start heading into a recession or a slowdown, what tends to happen is things become broad-based. It doesn't matter the type of job, doesn't matter age. Everybody starts to feel the same way. But yet, as the article suggested, the spending remains strong. Now, is it possible that people will lose confidence and then stop spending? You bet. Happens all the time. And here you can see the University of Michigan Consumer Sentiment Survey, only because we don't have the conference board data at, of course, the St. Louis Fred database against advanced retail sales. This is in red, showed on a year-over-year rate of change. And what's key here to note is typically consumer sentiment declines and then you get an eventual decline in spending. So there is some outlook that says, things aren't looking that good, but maybe they'll turn around. And then when they don't, as you can see, spending comes down. You see it here in the global financial crisis. We note consumer sentiment plunge, and then with a lag, retail sales followed. Here you see it again. We note that at the same time retail sales came down, it was only a lead on consumer sentiment falling. Now we've had a rebound in sentiment. We've noted, at least from the University of Michigan data and now the Conference Board, that data is indeed coming down. And what this suggests is even though consumers can continue spending now, there's a point where they realize that, wait a minute, maybe my expectations for the future are actually coming true. And then all of a sudden, spending declines in a big way. Expectations for the next 6 months stayed below the recession threshold of 80, reflecting a decline in confidence about future business conditions, job availability. We'll talk about that in a moment, and incomes. And yes, we've got some new information on that as well. The continued skepticism about the future is notable, given U.S. consumers, at least through the third quarter this year, continued to spend heavily on both goods and services. And why does that matter about the third quarter? Well, we know, according to Federal Reserve data, that suggested the pandemic money would be spent out somewhere around the end of the third quarter. We saw a big increase in credit card usage. And of course, the student loan repayments hadn't started back yet. So all of a sudden, perhaps outlook is now changing, despite as we look backwards and see rather strong spending. Expectations that interest rates will rise in the year ahead ticked up in October, although those expectations certainly are going to be dashed as of today, and the outlook for stock prices weakened slightly will make the case why the equity market also likely to come down. Furthermore, average 12-month inflation expectations increase in October, and the measure of expected family financial situation 6 months hence, not including calculating the expectations index, continue to fall, suggesting that families have a darker outlook about their finances, and when that happens, they start to curtail spending. Of course, you have to remember a lot of this data that we get, particularly from the government, is not real-time data because they don't have access to it any more than we do, short of maybe going out and just seeing what people are out doing on a day-to-day basis. But what we do know is the trend continues to be lower, but yet what we found out yesterday is there seemed to be, for some reason, a surge in job openings, which would suggest that the labor market is about to boom as there are now more jobs available, continue to be more jobs available than there are those on unemployment. And U.S. job openings unexpectedly rise in the second month to 9.6 million. Now, keep in mind, we talked about the unemployment data yesterday on the weekly claims, and what do we find out? That the number of people on continued claims continues to rise, and yet here we're seeing from the government suggesting there's a ton of jobs available, so something here isn't adding up at all. The so-called quits rate, which measures voluntary job leavers as a share of total employment, held steady at 2.3% for a third month and the lowest since the start of 2021. A more moderate level of quits implies Americans are less confident in their ability to find another job in the current market. I'll give you a different perspective. When everyone sees the economy is slowing down, they go to work and they say, hey, we don't have that many new orders, and we're working through our backlog of old orders. The thing you're thinking now is if you change jobs to go chase a higher wage, you're now one of the first people that are likely to be let go when there's a slowdown. So what happens is, in the mark of where you see a slowdown in the broad economy, people tend to quit their job less in hopes that maybe they're higher up on the list of people who are going to go when their employer cuts. While September advance wasn't particularly large, it added to more than 500,000 surge in the prior month. The latest pickup, which was fueled by a jump in openings at accommodation and food services, points to the resilience of the labor market. Of course, we're going to make the case why the worst case scenario for the labor market and the U.S. economy is coming, because when the labor market breaks, and we've got a bunch of new data to show what is coming, well, that means confidence is going to tank and the U.S. economy down with it. But what does that mean for the U.S. stock market? Well, according to the JOLTS data, it means stocks are way overpriced. And here you can see job openings. This is the JOLTS in blue against the Wilshire 5000. That's the total U.S. stock market in red. And what it suggests is, you notice there's a beautiful relationship here where job openings go, the stock market tends to follow. And what do we note? That job openings trending lower here, stock market heading higher, meaning either job openings need to surge a large amount or the stock market needs to find reality. I'll let you decide in the comments which direction you think. Should job openings be surging here, or should the stock market be tanking? What do you think? Weigh in the comments, because some economists have questioned the reliability of the JOLTS statistics, given the survey's low response rate, which is hilarious considering this is former Fed Chair Janet Yellen's favorite survey, and yet here you can see it is absolutely garbage. That skepticism has been compounded by stories of employers ghosting job seekers, a function of firms posting jobs they don't actually intend to fill. Some of you actually have commented about this in the past. It is a very real thing. And here you can see against the consumer sentiment survey back to the University of Michigan here in blue, against JOLTS, that's shown in red. And notice we see that when confidence falls, of course, job openings decline. We can see that relationship pretty clearly, except now we know confidence is rising at a time when the JOLTS is falling. So perhaps what we should see is, due to the lag effect of the JOLTS survey, maybe it should be rising. Maybe it's just a function that it is one of the most lagged and unreliable reports in the market that yet for some reason central bankers just happen to love. And the U.S. jobs data now shows broad cooling after a run of surprise strength, and this is a big change now in what we're seeing in the economy. We told you the labor market was likely to slow down, but one thing that should continue to be strong, well, that's your trading account, because if you had our Momentum Timer Pro, this is our tactical analysis report. It looks at all these technical indicators, smooths them all out for you so you don't have to boggle your mind with a bunch of lines on charts. And look at this. I want to show you, we talked about this potential trade maybe like 2 weeks ago, and they're the long bond. Here you see TLT got a 1 daily buy count on the Momentum report, and that was one of the 2 things you might remember that we say you got to watch for. Now keep in mind, right now you can lock in $20 a month on that, and I put 10 coupons out for a free month for not only the Momentum Timer Pro but CTA Timer Pro, so you can try them both out on me for a whole month. And we said when you see a switch from that minus 100% short, which it was on 11/1, here we see on our CTA Timer Pro report, this mimics the machine positioning. When you see both of those moving together, here we have it on November 2nd. It would say buy at open, and at the time of recording, that trade would be up 2.3%. Not a bad deal for 2 days. And of course, as you can see, one entire trade could pay for your subscription to both of them for a whole year, and not to mention all the benefits you'll get from them. So again, links in the description for both. I've got 10 coupon codes for a free month. Grab them before they're gone, because they usually go quick. But one thing that's also going quickly is the labor market. Here's the latest figure suggests some cracks are beginning to form in a jobs market that has been gradually normalizing thanks to improvement in labor supply over the past year and a tempering in a pace of hiring. So here you get some confusion here. We get the JOLT survey yesterday, and now we hear, well, maybe people aren't hiring as much. So yet for some reason they're posting job openings and not hiring. But notably, the idea here is there's an increase in supply of workers. Well, that actually changed as well, but the notable key here is the decline in the direction of the report. We had 150,000 people, according to the payroll report, but the general direction, and this is key, it's not a matter of the number, because that trend continues to be lower. What I want to show you here is we see the total non-farm in blue. Now I've cut off everything going at the pandemic and after, just so we can see it, and I've overlaid the current general activity, the diffusion index for the Philadelphia Fed manufacturing survey. And what do we find out? Where manufacturing goes in blue, well, or where manufacturing goes in red, payrolls fall. You see it each and every time it happens. And what have we noted in our show the other day is that the manufacturing sector is indeed declining. And what happened? We're seeing the Philly Fed data roll over. We're seeing all these other survey data roll over. And all of a sudden, the non-farm payroll report is just following suit. It's a downward trend now, and that is unlikely to change anytime soon. The rise in unemployment rate points to a pickup in layoffs, a development employers had so far broadly avoided, again, something the policymakers said isn't likely to happen. A survey of households showed more than 200,000 increase, and those who lost their job were completed a temporary one, again, showing sign of household stress, possibly one of those reasons we're seeing consumer confidence fall. Of course, we know that consumer confidence is highly linked to the labor market, so when people start losing their job for some reason, and sure you can understand, they lose confidence in the economy and then they stop spending. It makes perfect sense. But here we can see a change in payrolls, up 150,000. The unemployment rate up slightly to 3.9%. And here's a key thing that we've talked about on the show. We're going to look at this in a little bit. Average hourly earnings only up 0.2%. Again, the Fed has been concerned about this wage price spiral where higher wages will lead to more demand and consumption and drive prices higher. We said, no way, not a chance. We've got a chart on this. Stay tuned in a bit. So we're going to show you that everything is headed down just as we have suggested. Healthcare and social assistance as well. Government drove payroll gains. Other categories showed tepid growth or outright declines. Manufacturing payrolls fell by 35,000 in October, largely a fraction of the UAW strike. Of course, we'll see if that actually holds true. Now, obviously, some of those people are going back to work, but are we going to see further layoffs in the manufacturing sector? Well, the survey from the ISM, as you remember just the other day, said, yes, we are, and that is a huge problem. The hit will prove temporary, though, given union members have since struck tentative deals with the nation's largest automakers. And here we see easing demand for workers is putting downward pressure on wage growth. Just as we had predicted, average hourly earnings rose 0.2% last month, and we're up 4.1% from a year ago, the smallest annual advance since mid-2021. Again, a trend that's slowing here. Earnings for non-supervisory employees who make up a majority of workers increased 0.3% for a second month in a departure from a recent trend. The supply of labor declined, prompting a drop in the participation rate. So here we already get, do you see kind of what's going on here? You get the JOLT survey that says, look, there's all these jobs. And then we get the weekly unemployment data that says continued claims are rising, suggesting there's a mismatch. If there's all these jobs, why aren't people getting them? And then what did we see earlier in the story? It said, well, there's just demand for labor. Well, not really, because look at this. The shared population that's working or looking for work has fallen to 62.7% for those ages 25 to 54. Participation decreased to a 6-month low, driven by men. So clearly, all these jobs out there, they must be made up, because obviously people would be coming into the workforce, and those who are kind of disenfranchised from work right now because they're on unemployment should have no issue finding work, and yet it's all function. Total compensation growth is slowing. We've told you when this happens, unemployment claims eventually start to rise. The non-farm payroll report is just echoing what we already know to be true. And sure enough, what that they didn't say in that article was about average weekly hours worked, but we have that multiplied by average hourly earnings out of production and non-supervisory employees. And of course, we put that on a year-over-year rate of change, and we said this would continue to decline, because if employers cannot raise prices because there isn't demand, they can't give out wages, the trend here would eventually continue to decline. And sure enough, the trend is to the downside. The jobs report is composed of 2 surveys, one of households and one of businesses. While both showed signs of weakening, the household poll was particularly concerning due to rising unemployment, declining participation, and a drop in the number of employed workers. The smaller gain in payrolls, combined with slower wage growth and a drop in hours worked, finally now they admit it, led to a broad measure of labor market health to stagnate. Moreover, a gauge of take-home pay declined by the most since the start of 2022. So here we see finally the admittance that hours worked had declined, and now what do you see? The take-home pay declined by the most since 2022. Well, if your take-home pay is declining, and amidst that inflation is still here, and of course rents are rising still, we know grocery prices are there, energy prices, what does that mean? Less discretionary spending. You cut discretionary spending, then employers have no choice but to lay off. But of course, the Federal Reserve, they don't think that this is an issue. We're saying that this is everything, because once the labor market goes, the U.S. economy goes, that's the worst case scenario. But look at what this one member of the Fed had to say. Fed hiking cycle looks done after U.S. jobs report shows cooling. Well, we're going to get to him in a moment, because we've got to talk about Wells Fargo and Charles Schwab first. And here we can see, put a fork in it. They're done. This according to Wells Fargo's chief economist. If you're an FOMC official, which we'll talk about in a moment, this is what you wanted to see. This is good news for the Fed. No, this is terrible news for the Fed, because the Fed doesn't understand that once the economy starts to decelerate, it doesn't just stop land. It continues to go. That's the problem here. And of course, as I noted at the beginning of the show, Wells Fargo doesn't get it. But don't worry, Schwab doesn't get it either. Because here's the case, as we see the non-farm payroll report shown as a change in thousands of persons, just as you see the report normally, again, cutting off everything from the pandemic and on. I want you to see that normally when you see a slowdown in, of course, the non-farm payroll report and it turned negative, what normally happens? Well, you have here in red the federal funds rate, and notably, that means the Fed's usually cutting by now. And what are we hearing from the Fed? Well, they kind of want to keep rates elevated, but I want you to see in every instance, when you see a slowdown in payrolls, you see the Fed cutting rates. This is one of the few times, maybe one of the only times, they are not cutting and way behind. And that's why, again, we continue to suggest when the labor market goes, the Fed is going to be massively behind the curve and back down to zero. I know many of you disagree with it, but wait till we get there. We've been at zero before. We'll be there again. This is a really good report for the Fed. This from Charles Schwab's chief fixed income strategist. Again, I don't agree with this at all. It's a terrible report for the Fed because softer job growth with slightly higher unemployment and slowing wage growth, no change in Fed policy in December is likely. The Fed's rate hiking is probably done. Now, we knew it was probably done. We've been saying it should have been done a long time ago, and I just made the case the Fed should cut. But of course, what do we hear from the Fed? They're not done. Maybe not yet. Cooler jobs market won't rule out another hike, this according to Fed's Barkin. And though you know what, Barkin, I disagree with you completely. As we saw today that the data showed a gradual lessening of the job market. I think that's what those who would like to see, to not see another rate hike, would want to see. We'll see where inflation comes in. Well, guess what, Barkin? I just showed everybody what total compensation growth means, and it means inflation's coming down. In fact, maybe someone could send him this chart here, because what it suggests is that if consumers do not have money to continue to spend, then inflation must come down. The problem is inflation's coming down from a high level, and it comes down with a lag, and that means the Fed's going to keep interest rates elevated for too long, keep the money curves inverted for too long, and by the time the recession hits, it's over for the Fed and the bond market. They get it. As U.S. yields dive after jobs data, as traders move up rate cut bets, and we saw yields across the board decline, and even the dollar sinks to the lowest in 6 weeks as traders trim the Fed rate hike bets, because of course we know that even though there's no correlation between the dollar and the effective federal funds rate, that's not what the market believes. So notably both the dollar and yields declining, as we suggested, likely to happen. And yet the U.S. unemployment rise is on the verge of triggering a recession rule. This from a former member of the Federal Reserve, Claudia Sahm, posted at the start of the recession, when the 3-month moving average if the unemployment rate rises by half a percentage point or more, relative is low during the previous 12 months. Again, we've suggested the labor market, it doesn't matter how high it needs to go for unemployment. It's just a matter of how far off the low. And the low for joblessness so far this year is 3.4%. She said October's rate, the highest so far this year, following two readings at 3.8 in August and September, just shy of the 3.9% level that would trigger the Sahm rule and mean that we are indeed in a recession. When the labor market goes, my friends, that is the worst case scenario. It's game over for the U.S. economy, game over for the Fed, and you're going to watch the global economy along with yields come crashing down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.